all day on ET Now. Now let's get in a very special voice. Paul is now joining us, Chief Equity Strategist at Daiwa Capital. Paul, thank you so much for taking out time for us. Could you just first start by what's happening in emerging markets and what's happening in the developed markets? Because, the sentiments around both the markets seem to be very different.
Yes, good day, and thanks for inviting me on your show. So look, just basically sort of overall, we went risk off on equities as an asset class July 2 of this year, and the reason was that our roadmap, which we laid out in sort of November of last year, sort of called for a rally in the first half, driven by what was 10 months ago a non-consensus call that the Fed was done with tightening and the next move would be easing. That's obviously turned out to be the case, and that we'd see a slowdown, but an orderly slowdown of growth in 2019, and that would drive equities in the first half. In the second half, however, what we saw was that the focus would shift to 2020 earnings, and that we would see a much slower global growth environment, particularly from the second half of 2020, and that would be a major headway for equities as a whole. Now, the way in which we look at the globe doesn't really cut across DM and EM very neatly. The way in which we're actually looking at it is through the degree of sensitivity each individual economy has to the global trade cycle. Now, the global trade cycle is in recession, obviously negatively affected by the trade war, and those economies that are very heavily exposed to the tradable goods sector recession are Germany, Japan, Italy, Taiwan, Korea, and to some degree China. Those economies that are much more driven by domestic and regional demand are in a much better place. India, Brazil, emerging ASEAN, the United States. Now, I'm an Asia-Pacific strategist, and the way in which we've set up is that we've been for some time underweight Japan, overweight Asia ex-Japan. Biggest overweight in the region for at least a year now has been, or a bit less I should say, has been India, and much of emerging ASEAN. So Vietnam, Thailand, the Philippines, Indonesia, with big underweights in Korea and much of North Asia.
Right. So, Paul, let's talk about that India overweight that you were talking about. What is your sense as far as Indian markets go? What are the triggers to watch out for?
Right, so that's a good question. So the obvious, when we look at our investment process, we look at four inputs: valuation, earnings, policy, and macro. Now, on valuation, on a nominal basis, when we look at pure PE, on a pure sort of PE basis, India looks a little bit rich relative to the rest of the region and EM. However, if we adjust for earnings growth, and I overheard, the previous contributor, and I have a high degree of sympathy for that argument, that earnings growth is going to be superior in India than the rest of the region and the rest of global EM. And it's not just being driven by the impact of the tax cuts. Now, we don't need to sort of see much further than the impact on corporate earnings that the 2016 tax cuts in the United States had on U.S. corporate earnings. Now, this is an important driver that will be sort of the most important one for India. The other thing to bear in mind is that India still has plenty of monetary policy flexibility. So on monetary policy space, we're seeing falling inflation. Oil prices are falling, which is lowering the current account deficit. This is supporting the rupee, all things being equal. And this is important that we're seeing relative stability in the rupee against the backdrop of a strong U.S. dollar globally. So that I see as actually being quite supportive for Indian equities.
Right. When you just talk about, the Indian markets in terms of EPS growth or, the earnings growth, what are the numbers that you are predicting and what essentially is the consensus number?
Right. So as far as consensus, when we look at consensus earnings growth, just to give a little bit of a comparison here, when we look at Indian earnings growth, we're looking at consensus at around 18.7% this year. I think Indian earnings growth will exceed 25% this year, and possibly close to that point next year, if we really see the type of impetus come through from the impulse from the tax cuts. And that's sort of roughly speaking. What we can say though is that consensus is about 19%, but I think it will likely overshoot that.
Hi, Paul. Good afternoon. This is Nayantara Rai joining in from the New Delhi studio. So, we are, of course, seeing the global trade tensions running high. But if I were to talk about the Indian scenario in particular, in light of what is happening, the new tension between the US as well as the EU, the Brexit looming large, would you say it is an opportunity for a country like India? And is that perhaps also being backed by rejigging of global portfolios?
Yes, that's a good question. So I think one needs to be very careful here in the way we couch this. I think where the global economy is right now is that we're in the phase of this economic downturn that is fairly orderly. So our view is that we'll see an orderly slowdown in global growth until the fade from the effects from the U.S. tax cut stimulus or fiscal stimulus drops out of the data. Now, our view is that will become very apparent from around the end of Q2 next year. Now, once that happens, then global growth, we think, will slow down quite more significantly. Now, as I mentioned previously, equities as an asset class is concerned, given that equity markets tend to discount about 1 year ahead, we're already, if we look 1 year ahead from now, in that phase where we're likely to see a sharper slowdown in growth. We think equities as an asset class is fairly vulnerable at this particular point. So when we talk about the relative attractiveness of Indian equities, it's in the context of equities not being an attractive place to be.
Okay, so, then having said that, if I could put you in a spot over there and say that, while all of this is possible, about 6 months back, we would have said India is the darling. If not India, then where, right? So from a capital flow perspective, does that situation still hold true?
Right. So 6 months ago, people were concerned about the slowdown in growth. So I'd slightly push back on that thesis, because around the elections and leading into the elections, we saw growth slow down from what was on a full-year basis from 7% to below 6%. So I think what we're seeing now is the prospect on a forward-looking basis that the impact from the corporate tax cuts are likely to be a significant boost to growth, and I see that 7% being achievable now. Now, what has changed, of course, is that particular sort of tax cut event. Now, we had highlighted 6 months ago when we were positive on Indian equities, and they did underperform for a little while there. There's no doubt about that. They've caught up very quickly recently. But what we highlighted was the significant policy flexibility that India had at that time, both monetary and fiscal. Now, we've seen that already being enacted through cuts in the reverse repo rate and now through tax cuts. So we're seeing those two events combining together, and it's the interaction of monetary and fiscal policy that's actually quite powerful.
Okay, Paul, we're going to leave it at that. Always a pleasure chatting with you. Thanks so much for putting all of this in perspective for us. This is, of course, the big story that is unfolding globally at the moment. And you've got new trade tensions in, and a new opportunity, therefore, presents itself when it comes to the Indian markets, the Indian economy. And that's a picture that you're getting as far as capital flows go.